Hello, it's Brian Shannon from AlphaTrends.net. Today's Monday, the 30th of June, 2008, and the market closed. The S&P 500 finished actually with a gain of 30 cents. There's nothing bullish looking about this daily chart, of course. It's going to take a lot of time to heal this market properly before we can really start thinking bullishly again. So, a 30-cent gain really doesn't count for much when you have such a powerful downtrend, and it close to these lows that we've seen formed earlier back in January and March of this year. So we've got this market still kind of looking like, Friday was the all-time, the closing low for this year for 2008, and that weekly time frame still looks pretty vulnerable as far as a breakdown through here, and then at least a test of 125, I think, and then you could probably look at for prices even lower than that, maybe testing the lows from 2006 down near 122 or so. Point is, we still remain locked in a downtrend, and that's not going to change quickly. As I pointed out last week, this 30-minute time frame is really just a picture-perfect downtrend here, where we see these prior levels of support acting as resistance as the market stair steps lower. It tests the support a couple times and then acts as resistance. Now, if we're to get a test of prior support, that would occur at about 130 and a half right now. We do have a declining 5-day moving average, and that means this market should be treated as guilty till proven innocent. I had pointed out earlier in the day, actually on the cues, that there might have been a possibility of a little bit of bounce, but you can see here that that we saw a little bit of strength early on in the S&P, but with a declining 5-day moving average, you can't really trust those rallies too much, and they should only be traded, if you're going to trade them, for very short term on the 1-minute time frame and that sort of thing. Pull back to the VWAP and then breaks out here. Then we saw a nice little pattern of higher highs and higher lows, but that was interrupted right here. So there's really not much action right now, and it feels like maybe today we had light volume in here, and we see that perhaps this is we do have a holiday shortened week this week, with 4th of July being on Friday. So I think we're going to see a pretty quiet week, but we're in a downtrend. So they say don't sell short a dull market, but when the trend is clearly this bad, then you've got to continue to just play a very strong defense. I'll be out most of the week. In fact, I think I'll probably do a video tomorrow, but after that, I won't be around. So again, the 1-minute time frame we see in here, that the sellers came in right at the end of the day, right at the end of the quarter. So the market remains vulnerable. Nothing's changed. Obviously, a 30-cent move isn't gonna change anything. The Russell 2000, I thought this market looked like it probably had the greatest potential for further downside. It actually tied the Nasdaq in terms of percentage move today, with its loss of 1%. But we did see a 75-cent decline in here on the Russell 2000 today, and we've got a similar-looking downtrend in here. In order for this market to be taken even partially seriously on the long side, it's going to have to get up at least past 70 and a half, probably more likely up here, because this is the level at about 71.75, where we see that the neckline of the head and shoulders pattern that we've been seeing. So we've got this, of course, this being the head and shoulders pattern. This was the break of that neckline, the test, and then we see, of course, a nice pattern of lower highs and lower lows. Subsequently, since there, we've got the same thing here with the declining 5-day moving average. Any and all rally attempts should be treated, very suspiciously. Short term, we've got a little bit of resistance that's formed at 70 and a quarter. If it moves again up above that and is able to recapture the 5-day moving average, then perhaps it rallies up towards the 71 to 71 and a half level, but odds don't favor it. We've got a badly damaged market here. I really probably even should be talking about the long side in here, as long as things remain so weak, because they're just, I still think that this market has a good chance of coming back down towards that 64 level, and if that's if that's what you believe as well, then you ought to be looking more at the pro shares, the TWM. That would put this market up near about 95 if the IWM was to drop down towards its annual low down here near 64. And of course, if 64 is not going to hold, then we've got the potential for a bigger break here on the weekly monthly time frame. But let's just keep our eye on what we've seen so far, which is these lows near 64, and just continue to treat it very cautiously. The financials are a great group to look at, to remember that as bad as it seems, it can get worse. There's no such thing as down too much as long as someone else is willing to sell, and your perception of value and what a good company is and that sort of thing just don't matter. When the markets get into these strong trends, they value and logic go out the window, and maybe what appears to be illogical moves are actually going to show us that there was a good reason for it, as the news and the surprises have been following the trend here in the financials, and as they often do in any market movement. This most recent sell-off, really from 28 and a half or so down to 20, is getting stretched, and we've seen that these sharp sell-offs produce some violent short squeeze rallies. But those rallies, when and if it comes, the next one comes, don't trust it. If you trade it, treat it as a trade only. Markets heal through price and through price, and then they heal through time. And it's going to take a lot of time for Wall Street to trust this group again before they begin to realize that yes, all the bad news has been purged from this market, and that the practices that got us into this mess have been fixed, and it takes quite a long time. You can see here on the financials we're getting down towards these lows from 2000, 2002, and 2003. So they just remain a badly damaged market. I don't think dollar cost averaging makes sense, or trying to pick the bottom. Just you're better off staying away. The Nasdaq 100 lost about 48 cents or 1% today, and obviously there's no signs in here that this market is beginning to turn. I thought maybe getting above 40 I think it was 45.80 might produce a short squeeze rally a little bit in here today. It got above that to 40 or 45.83, but obviously it didn't hold on in there. And here's that, I thought maybe above 45.80 as it was above the daily VWAP and that sort of thing. But I said that only the most aggressive and disciplined traders should be looking at it. When it breaks back down below the the VWAP and that sort of thing, all bets off. This market continues, closed right on the lows for the day. Looking at a 10-minute time frame, it doesn't seem like there's any reason to expect this market not to test and probably violate this low near 45. And no matter what time frame you look at it, it's just a big mess here. Probably headed back down towards this low here from April, near $44 a share, and it's just a bad looking market. So just continue to be very cautious and defensive.